Well, hello Internet, and welcome to my financial statements tutorial in which I will explain exactly how all the financial statements work that are used within a business. And I'm going to use a real-world example in this tutorial. I'm going to fill in step by step the financial statements and explain what all the jargon means through the use of a fake caricature drawing business. This tutorial came together because I received this request from Anne, and she did not want me to give her last name. First off, I'm going to go over the balance sheet. The balance sheet describes a business's financial situation at a moment in time. The left side details the assets a business has, and the right side details how those assets were acquired. At all times, both sides must remain equal. And you can see in the lower right hand corner, a very simple way to start a business is with cash and an original investment by me, the owner. Of course, most businesses start off with a loan, and your rich uncle decides to give you $100 and he expects 10% interest to be paid on that $100 loan sometime within a year's time. A long-term loan that includes interest is known as a notes payable. And you can see in the lower right hand corner here, now I have an original investment plus the loan from my uncle, also known as a notes payable. And when you add those two things up, you get my cash amount, which is $200. Now there are two different types of owners of a business. There are people the business owes money to, or liabilities. See, I changed the right side to the word liabilities. And then there's the part of the business the owner owns. This is known as owner's equity. And you can see here original investment lies under owner's equity, and everything else still equals out. And also you're going to learn the most important equation in whenever it comes to balance sheets, and that is that assets always will be equal to liabilities plus owner's equity. Inventory is what you sell. When you buy inventory, you decrease the value of cash. You do not decrease anything else or change anything else. So whenever you purchase $50 of inventory, you're going to get, for your caricature drawing business, 50 sheets of paper, which cost a total of $35, and then you're going to get $15 worth of markers and colored pencils. And this inventory is going to allow you to create exactly 50 caricatures in my sample business. Now let's say you go to a party later on that night and you draw 40 caricatures for $2 a piece. That is $80 in total sales. Well, that would mean that your unit cost is equal to the price of inventory to create one finished good. So if you have $50 in inventory and that inventory creates 50 caricatures, that means your unit cost is $1. Now, cost of goods sold is going to equal out to $40. And what that means, just quite simply, is you sold 40 caricatures, as I detailed above, at a unit cost of $1 each. So it cost you $40 to create the goods that you then sold for $80. You would then subtract the cost of goods sold from your total sales of $80 to find your gross profit. And gross profit is just simply, as I have here, sales minus cost of the goods that you sold, and net profit, as you're going to find out later, is gross profit minus any additional expenses. So let's look at this more closely. We started off with $200 in cash, which came from our original investment and the notes payable from our uncle. We bought $50 worth of inventory, and then we made a total number of sales of $80. That's how we get the cash amount here of $230. Well, you can see down here I have earnings week ending. This is another part of the balance sheet I'm introducing here for the first time. How I was able to calculate this is to take the total number of sales minus the cost of goods sold, which is $40, to get a final earnings week ending of $40. And if you add both of these sides up, you come to the same number, being $240. You've decided it's time to expand. You've decided to increase the price of your caricatures to $5 each, to rent a space at the mall for $80 per day, and to buy a sign and an easel for a total of $50. You then go on to buy $50 in raw material inventory. Raw material inventory is inventory that is not prepared to sell. It will become a finished good, as you're going to see here in a minute, right after you're done making the drawing. Well, let's say that your first day at the mall, you make $300 in total sales by selling 60 caricatures. That's 60 times $5, as we have up here at the top. And you're also going to see here a new piece of the balance sheet being retained earnings of $40. That was from the $40 that you made during your first day as a caricature artist. And you see here your additional sales of $110 And on the next slide, I'm going to go through exactly how that was calculated. You can see here, what I did was I took my previous cash amount of $230, subtracted out the $130 that I used to buy the easel and all the other additional things, subtract out the cost of my inventory, and then added my total sales to get $350. And I was able to calculate earnings week ending, which is over here, by taking my total expenses out and my total cost of goods sold and adding in my total sales to reach an amount of $110. And then if you add all of these things up, you come to $350. Most errors in accounting are caused because of a lack of understanding on how to calculate earnings week to date. And another financial statement, the income statement, helps you to avoid making that mistake. An income statement is normally updated on a weekly basis, while balance sheets can sometimes go for months without being updated. So what I did here was I took my first day at the mall and I put my sales in the upper right hand corner, and this is the basics of what an income statement looks like. Then I take my beginning inventory, because remember on my first day I had $50 of inventory to sell and I only sold 40 caricatures, so that's what this is. Then I went out and bought additional $50 worth of paper and markers, put that there. Then I add all these up and put the total amount of inventory that's available to sell, and then the amount of inventory left over after my first day at the mall, which was 0. That gets me my total costs of goods sold, which is $60. I subtract that from the sales amount. I then subtract out my rent, my sign, my easel, my total expenses, and that's where I came up with the number 110. If you look over here, that's what you got, earnings week ending. So this is the reason why you use an income statement. It allows you to keep everything straight. Because let's say I didn't sell all of my inventory. Well, and this is a common error, let's say I only sold $50 of my total inventory. Well, I would only subtract $50 from this $300 and leave the additional $10 here in ending inventory. That would keep everything straight. You do not subtract out all of your inventory from your sales to reach your earnings week ending. You instead only subtract out the cost for the inventory that you sold. And I'm going to do a ton more examples. Believe me, this is going to become completely understandable. Your second week in business, you decide to rent the mall booth for 3 days for a total of $240 in rent. You spend an additional $150 on raw materials and use $25 of the raw materials to create celebrity pictures. These are what are called finished goods, like I had mentioned previously. You sell 125 caricatures, but no celebrity pictures. Here you have your total sales of $625. Your beginning inventory, remember we sold out last time, so we had none. Your total cost for paper and markers. And this ending inventory represents the celebrity pictures you did not sell. So we're going to subtract that out. 125 minus 625, leaving a gross profit of $500 minus the cost in rent, which was $240 for 3 days. Move that expense over here and come to your final net profit, which is also going to be equal to your earnings week to date. And go here again, we can look at how to transfer that over to the balance sheet by taking the previous cash minus the inventory minus rent plus sales. And that's how you get $585 here for cash. Then you have your finished goods, which were the celebrity pictures that you did not sell. You want to leave them in there. And then you find your earnings week to date of $260 by taking your total sales minus cost of goods sold minus expenses. And you can see here over in retained earnings that I moved up my previous earnings week ending to retained earnings. I decided to reinvest them back into the business. If you add all of these up, you'll come to $610. Well, as you're leaving the mall and after you've finished your balance sheet, a friend comes by and offers to buy all of your celebrity pictures for $50 on credit. When somebody buys something from you on credit, it is called an accounts receivable, meaning money that you expect to receive. The mall operator then walks up to you and says that he wants 1/2 up front or $120. Well, since you are not going to immediately start renting the mall at that point in time, this is what is called a prepaid expense. And you would also put this over here under your inventory. So you would put your prepaid expense of $120 here and subtract it from cash. You would put your accounts receivable here of $50, and then you would add the additional $50 over here to earnings week ending. You add all these up, comes to $635. So what happens if that debt your friend said he would pay to you, he doesn't pay to you? Real simple. Delete the amount that's in accounts receivable, then come down to earnings week ending and subtract that $50 from here as well. but do not touch retained earnings. If you had already moved this 235 up into retained earnings, this would have an amount of negative $50. So let's review. Cash is cash, real simple. Inventory is made up of raw materials and finished goods and prepaid expenses. Accounts receivable are payments made in credit. Prepaid expenses are payments made in advance of receiving benefits. Cost of inventory and prepaid expenses are subtracted from cash whenever they are purchased. And let's review liabilities. Accounts payable are short-term loans due in a month's time roughly, and they normally don't require interest payments. However, the loan that you received from your uncle was a notes payable because it's a long-term loan that does indeed require interest payments. And let's review equity. The original investment is the owner's investment in the company. Retained earnings are earnings that have been reinvested into the company. Earnings week to date is found by subtracting cost of goods sold and expenses from sales. And you can find that information over on your income statement. And bad debt is subtracted from earnings. I hope that was very understandable. In the next presentation, I'm going to go over paying off your debt to your uncle, hiring an employee and how that changes your balance sheet and income statement, buying with credit, and the different accounting methods available. If you have any questions or comments, leave them in the comments section below. Till next time.